Hey everyone, welcome back to Corporate Decoder, the place where we uncork those corporate filings to see if the numbers are singing or screaming. Today we're diving into Capital One's latest report, and it looks like they're giving us a peek at some pretty sensitive data. We're talking about their delinquencies and charge-offs, which, let me tell you, are like the vital signs of a credit card company. Stick around, this one's a real window into how they're handling money. So, what we have here is essentially a monthly update from Capital One Financial Corporation, and it's not your typical earnings report. This is more like a health checkup, focusing on how many people are struggling to pay back what they owe, and how much money the company feels it has to write off as a loss. Think of it like this: if you lend money to friends and some can't pay you back, that's a delinquency. If you finally decide you're never getting that money back, that's a charge-off, a real loss. This report covers the month ending the 31st of October 2025. Now, why is this important? Because in the credit card business, timing is everything. Even small shifts in who pays and who doesn't can mean big swings in profits. Capital One is giving us this information through a special disclosure called Regulation FD, which is all about making sure investors get important news at the same time. They're not technically filing this as a part of their main financial statements, but it is still crucial information for anyone watching the company. Let's look at the different types of financial products they're reporting on. We see common stock, which is what most people think of when they hear stock, but then it branches out into various preferred stock series, like Series I, J, K, L, and N preferred. Stock is a bit different. It usually pays a fixed dividend and has a higher claim on assets than common stock. If the company were to go belly up, it is like a more secure slice of the pie for those investors. Then there are the senior notes due 2029. These are basically loans that Capital One took out from investors, promising to pay them back by the year 2029 with a specific interest rate. It's how companies raise a lot of money without selling more ownership. The key takeaway from looking at all these different stock and debt types is that Capital One has a pretty complex financial structure. They're not just a simple bank, they're managing a lot of different obligations and capital sources, and the performance of each can impact the others. Now, what do these charge-off and delinquency numbers tell us about the overall health of Capital One? Especially in late 2025. Imagine the economy has been a bit wobbly. People lose jobs and suddenly they can't afford their credit card payments. Those become delinquencies. If enough people can't pay back their debts, the bank has to accept that they've lost that money. And that's a charge-off. When I look at a filing like this, I'm not just looking for a single number, I'm looking for trends. Are the delinquencies going up? Are the charge-offs higher than they were last month? Or last year? This tells us if the company's customers are generally doing better or worse financially. It's a direct reflection of economic conditions and how well Capital One's lending practices are holding up. It is important to remember that these are metrics for a specific month, so we can't draw ironclad conclusions yet. However, they are critical leading indicators. If delinquencies start creeping up, it is often a sign that charge-offs will follow in the next few months. It is like watching a storm gather on the horizon. In my experience, when companies are upfront about these numbers, it usually means they're either seeing good results they want to share early, or they're preparing investors for some less than ideal figures. Without the actual numbers from Exhibit 99.1, which is the detailed monthly metric report, it's hard to give a precise analysis of the trends. But the fact that they are highlighting this specific data in an 8, K filing suggests it's a key area of focus for them and for investors right now. Looking at the broader picture, Capital One, like other financial institutions, thrives on managing risk. They make money by lending at higher rates than they pay for funds, but that only works if their borrowers pay them back. So monitoring these charge-off and delinquency rates is as fundamental as checking a company's revenue and profit margins. We can also see that Capital One's various financial products, including its common stock and multiple series of preferred stock, are all traded on major exchanges like the New York Stock Exchange. This tells us they are a significant publicly traded company with a lot of eyes on their performance. The company's financial health, as indicated by these charge-off and delinquency metrics, directly impacts how investors perceive the risk of holding these securities. When we see companies like Capital One furnishing these kinds of details so prominently, it signifies a commitment to transparency or perhaps a need to get ahead of potential investor concerns. It's always wise to see how these metrics compare to industry averages and to Capital One's own historical performance. For example, if charge-offs are ticking up while competitors are showing steady or declining rates, that's a red flag. Ultimately, this filing is a snapshot. It tells us Capital One is actively tracking and choosing to share its delinquencies and charge-offs for October 2025. The real story will unfold when we get to see the actual figures and compare them to prior periods and to their own future reports. It's a crucial piece of the puzzle for understanding their risk management and overall financial stability in the coming months. Based on this filing, Capital One is being unusually transparent about its charge-off and delinquency metrics, which is usually a good sign for investors looking for accuracy. The company operates in a very competitive and highly regulated environment. Its strengths lie in its brand recognition and its ability to leverage technology to manage its large customer base. However, a key weakness for any credit card company, and likely for Capital One, is its sensitivity to economic downturns. When people lose jobs or face financial hardship, their ability to repay credit card debt plummets, leading to higher delinquencies and charge-offs. This report, by highlighting these metrics, is essentially giving us a peek under the hood at potential economic headwinds. The main risk here, as with any financial institution, is a significant increase in defaults. If the overall economy struggles, Capital One could see a substantial rise in the amount of money it has to write off. On the other hand, if the economy remains strong, these metrics will likely stay manageable, allowing the company to continue its growth trajectory. My conclusion is that while this filing doesn't give us the specific numbers to make a definitive judgment, the act of reporting these specific metrics is noteworthy. It suggests management is either confident in their numbers or is preparing the market for what's to come. Investors should absolutely be paying close attention to the actual data in Exhibit 99.1 when it becomes available, and track these trends closely in future filings. Alright, that is our breakdown of Capital One's latest report. What is your take on these metrics and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.